Participants, welcome to today's webinar on Fixed Income Market Insight, where we discuss what went by in the previous month and our outlook going forward. As you all are aware, India got included in the global emerging market indices last month finally. US Federal Reserve left the Fed funds target range unchanged at 525-550% range in its June meeting. Further, we have two major events lined up in the coming weeks. Budget for FY 2025 to be tabled on July 23 and RBI monetary policy meeting is scheduled in early August. I am Sonal Mittal, product specialist, and our head fixed income, Mr. Anurag Mittal, is joining us today to share his insights and perspectives on the bond market updates and outlook. Post remarks from Anurag, we will take up question and answers. Please note, you can post your questions on the link provided to you anytime during this webinar to make the most of this opportunity. Without further ado, I will now hand over to Anurag. Over to you, Anurag.
Sonal, good day, everyone, and welcome to UTI's Market Insight for fixed income for the month of July 2024. So, as usual, we'll start with key global trends, and then we'll switch to the domestic trends and share our outlook and the right product strategies for the same. So, starting with major global trends, the year 2024 has been kind of a mirror image of 2023 as far as growth is concerned. So when we started the year 2023, the expectation was that probably the best of manufacturing as well as services growth has been behind us. So if you see the left-hand side chart, which depicts the manufacturing PMI and services PMI, it had started to falter somewhere in the middle of 2023. And when we started the year 2024 as well, that was the expectation that probably growth will be slow across. But as we can see, both on services as well as on manufacturing side, growth has picked up. And overall growth has been led by especially the US. It was expected initially that probably the savings pool that consumers had accumulated during COVID had run out and consumption will slow down. But two things have helped carry the consumption story so far. One is that because of supply chain normalization, the profitability of firms has been strong, and hence there has been decent hiring pace across sectors in the US so far. And if you look at on the household net worth, while it has declined compared to the COVID levels, nevertheless it still remains quite robust and healthy thanks to the wealth effect from the financial market as well as from the real estate market. So broadly, the growth has been quite strong. In fact, on the expectations as well, growth expectations have been revised higher in the US and the other major economies. And if you look at on the right hand side, both on the advanced economies and on the emerging economies, industrial production has been quite healthy. As we can see, after bottoming out in 2023, the advanced economy industrial production has been on an uptrend. And if you look at the emerging economy, which is the black line, that uptrend has been quite strong since 2023. And hence, the risk of a downward surprise has increased because as the expectations now have moved on to a slightly higher trajectory, in case of any downward surprise, probably the market participants may take it more negatively than so far. Looking at the commodity and the food index, which has an important bearing on inflation. So as we can see, while commodities have been range bound for the period of 2023-24, for particularly for the month of June, they fell month on month, led by metals on a stronger dollar, as well as uncertainty surrounding China. With the recent trade tensions between China and the US. Mind you, dollar and commodities traditionally have had inverse correlation. That means there are in the days where US dollar is stronger, and since most of the commodities are traded in dollars, typically commodities tend to correct in such times, and vice versa. And hence, since the dollar was quite strong for the month of June, we saw some correction in commodities. If we look at the food index remained quite stable in June. As we can see on the chart, while it has come off from its sharp declines in 2023, yet the index remains in a negative zone. If we look at for the month of June, there was a correct increase in sugar and oil prices, which was offset by uh, decline in cereal prices because of record production in major exporting economies. So overall, food inflation remains reasonably managed. Commodities also remain range bound, which overall is positive from an inflation standpoint. If you look at how inflation is really faring out, so as we can see, inflation has been coming off for most of the major economies since 2023. However, as we can see for the US, UK, Eurozone, etc., it's still quite sticky around 2.5 to 3%. And hence the pace of disinflation is slightly gradual, and it is also quite divergent in many economies. So, for example, if you look at China, China has been consistently on the lower side, despite a lot of stimulus efforts. Inflation in China is not really picking up. But if you look at other economies, inflation has been tended to be quite sticky. One of the reasons behind the sticky inflation has been still strong global growth, which we saw on the first slide, and hence we should expect a shallow rate cut cycles in the near term till the time growth continues to be healthy. If you look at the 10-year sovereign yield movement in key economies, so we saw peak bearishness in the month of April. If you look at, for example, the US 10-year sovereign yield, it rose from 4.2% in March of 2024 to almost 4.7% in April 24. Since then, it has been declining. If you look at the trend across major economies, it's been the same whether you look at Germany or UK, or whether you look at, for example, South Korea or even Indonesia, etc. Largely, uh, the decline in yields have been a result of softer inflation trends. And as inflation trends from April onwards have been encouraging across major economies, there is an increasing expectation amongst the market participants that we should see some amount of rate cuts in the calendar year 2024 as well. And that's led to this decline in yields consistently from the month of April onwards. We talked about market expectations of interest rates. As we can see on the right hand side, this is the market implied policy rate forecast. So as we can see, it's still pricing about 50 basis of rate cuts, in the calendar year 2024. So in the next 5 odd months, market participants are still expecting 50 basis rate cuts from the Federal Reserve, especially after June's inflation. The odds of a rate cut in September have gone up almost 80%. So there is an expectation that if the inflation trend continues to be similar, we are likely looking at the first rate cut from the US Federal Reserve in September. If you look at on the left hand side, which is the US Financial Conditions Index, which is a combination of credit spreads, equity valuations, as well as bond yield curve, etc., that continues to be still easy, reflecting markets comfort and markets pricing in of stronger growth. and softer inflation, which is leading to both equity markets as well as bond markets remaining quite healthy. Coming to the domestic trends now, if you look at the domestic inflation rate, which is the CPI and core inflation, if you look at the June inflation, which was printed last week, the June inflation saw an uptick from 4.75% to 5.1%. Which the food inflation in June was the main driver of this increase, which rose to 8.4% to somewhere close to 7% in the month of May. One of the main reasons was the intense heat wave which we saw during June, which resulted in major increase in vegetable prices. So if we look at CPI ex vegetable prices, that was just at 3.5%. And if you compare it to the calendar year to date average, which is around 3.6%, it shows that overall inflation, excluding vegetables, has been stable. The uptick was largely due to the one-off shock that we saw. If we recall, both the IMD as well as the RBI had cautioned against the intense heat wave, and RBI had mentioned that inflation could be volatile in the coming months because of these extreme weather conditions, and which has panned out. And it also explains the cautious stance or the cautious tone that RBI struck out in the month of June. But from a bond investors or a market participants perspective, what is positive is if you look at the core inflation, which is the red line, that continues to be in the same downward trajectory. It is behaving quite moderately, like we discussed. If you look at CPI by stripping out vegetable prices, it's still at 3.5%. If you look at the diffusion index, which basically aggregates the weight of constituents more than 5% inflation, that also continues to be in the similar trends as we have seen in the last 6 months. So probably on the balance, there is nothing alarming about inflation. Uh, in the next 1 2 months, inflation could surprise on the upwards. As core inflation could get revised ongoing because of the mobile tariff hikes which have happened. So telecom and communication has some weightage in the core inflation, which could see revision due to the recent mobile tariff hikes which have happened. So probably even going ahead for next 1 2 months, inflation could remain slightly higher. On the positive side, these telecom tariff hikes are one-offs, and we don't really expect RBI to be concerned about these issues unless and until there is a second round impact. As of now, we really don't see any second round impact of these tariff hikes, and hence we still think that overall inflationary trend is healthy for market participants. One of the major drivers, like we saw, of inflation in the previous slide was food inflation. And again, food inflation, just like it spiked up because of an intense heat wave, the future trajectory of food inflation will be shaped very significantly because of how monsoon pans out in the month of June to September. If we look at the end of June 30th, India had received 11% aggregate deficit rainfall. Mind you, IMD terms a normal monsoon as something which is in the range of 96 to 104% of long period average. So we were seeing a deficient monsoon till the month of June, especially if you look at apart from South, every region was experiencing a very, very high deficiency. But as we can see the trend changing very drastically from June 30th, a deficit of minus 11% has just come to a deficit of minus 2%. And so from a deficient rainfall, now we are close to a normal rainfall in India. If you look at the deficiency northwest, from a 33% negative, it's just gone to minus 8%, and even the current trends are quite constructive. If we look at central India as well, from minus 14, it's come to minus 7%. South Peninsula continues to maintain an excessive monsoon characteristic. And if you look at east and northeast as well, from minus 13%, it's come to -1%. So overall, monsoon has been encouraging. So if we look at the future trajectory of food inflation, it's likely to be much more benign if the current trend of monsoon continues at its current pace. If you look at the sowing data, for example, for rice, uh, it's flat, but for pulses, the pulses sowing has increased by 181%, and oil seeds, which also have a large impact on overall food inflation, the sowing there has increased by 155% year on year. So overall, both the rainfall as well as sowing data are quite benign for food inflation going ahead. Of course, the impact of these measures will be seen probably in a couple of months. So there might not be any immediate impact, but from a RBI perspective, it can give comfort to RBI if the current trends on monsoon as well as sowing continue in the same manner. If the second important aspect, which also has an impact on food inflation, are the hikes in minimum support prices. Since government sets up, minimum support prices, it often acts as a floor to many of these food commodities, most notably, the rice and some cereals. If you look at the 2025 MSP price hikes, they have been quite moderate. So one of the concerns that market participants had post elections that probably the government could be slightly more populist than usual, and they may go for very aggressive MSP hikes. But if you look at the CPI weighted increase in MSP, it's in line with the recent trends and quite moderate. And again, it bodes well for inflation. So it's not that lower MSPs were because of a certain design by the government. They were largely reflecting the moderation of input cost and were in line with the Committee on Agriculture pricing recommendations. So the second important aspect is in many of these commodities, the market prices of these commodities for now are higher than the MSP prices. So again, the MSP prices incrementally don't really have an impact on food inflation going ahead. So both from monsoon, from sowing, as well as MSPs, overall outlook on food inflation seems to be constructive in the near term. The the other important aspect in the bond market, which has to be seen going ahead as well, was India's inclusion in JP Morgan Bond Index on 28th of June. It was widely expected that uh, the index inclusion will lead to about 25 to 30 billion of flows, and some market participants were expecting a major rally. We were always of the opinion at UTI that some amount of flows have already come in post the announcement, because the active funds which are tracking the JP Morgan GPI EM index could have purchased many of these securities even before the actual inclusion date. So the outperformance that Indian bonds saw against many of the Asian counterparts were probably a reflection of the strong FPI interest in Indian government bonds. So as we can see from this chart, the announcement of the index inclusion was made in September 2023. So this, if you look at the blue line, which is the far foreign ownership, which basically reflects the foreign investor participation in fully accessible route securities. To clarify, not all bonds can be bought by foreign investors in an unlimited manner. There are certain limits that foreign investors have on Indian government bonds. But RBI in 2020 brought out a separate foreign accessible route securities where foreign participants can buy unlimited number of bonds in a way, and so there is no limit on the bonds. And so largely JP Morgan has included FAR securities and its index. So if you look at the blue line, which shows the ownership of FAR securities, it has been increasing quite aggressively. So from about 2.7%, it's now almost 4.6% of outstanding amount, which is quite significant. If you look at the total foreign ownership of Indian government bonds, that's also increased in September. So if you look at the total expected flows, which were expected to be in the range of 25 to 30 billion, 8 billion have already come. And hence, we expect these flows to remain moderate in the near term. But nevertheless, they even a $1.5 billion of flow, which is expected to come, is expected to provide some cushion to bond prices in the months coming ahead. So both from inflation as from and as well as from demand supply, things look quite constructive for Indian fixed income. The state borrowing was also announced for the Q2 FY25. So as we can see, in the first quarter of FY25, against an announcement of about 2.5 lakh crores of SDL borrowing, only about 1.5 lakh crores or 57% of borrowing was conducted. So if we see in the last 3 years, the typical borrowing against the announcement has been in the range of 50 to 80%. So the 57% was on lower lines. One of the reasons was that the government of India or the central government had, you know, kind had aggressively spent their state allocation by giving the state loans and other expenditure to states to boost consumption and to boost growth, and that is why states were running higher cash and they did not need to borrow as per the announced calendar. If you look at the trend in Q2 in the previous 3 years, typically states have borrowed between 80 to 85% of their borrowing. So even if you assume a 85% borrowing, we expect demand supply dynamics of states to remain favorable, given they have high cash balances. And if you look at demand from long-only players such as pension funds, insurance, provident fund, etc., that remains quite strong. So we do expect bond or SDL spreads compared to GSEC to remain slightly on the tighter side. In fact, any budgetary support to states in the upcoming budget may further push out borrowing plan to upcoming quarters. So some of the borrowing which has been announced in Q2 may further get pushed in Q3 if the center were to give a slightly higher than expected number of state support in the upcoming budget. Update on the T-bill borrowing. So as we discussed, just like states, the center was also running a significant amount of cash coming into the quarter. One of the reasons for this high cash balance was the announcement of model code of conduct because of general elections. And unlike some of the previous election cycles, this election cycle was slightly in a longer phase, and hence the government was not able to spend all the tax collection because of model code of conduct being in place. So if you look at in Q1 FY25, the government reduced the borrowing, the T-bill borrowing by about 60,000 crores. Even if you look at Q2 FY25 compared to the maturities, government is planning to raise only about 85,000, or in fact less than the maturity. So the net T-bill issuance is tracking about 1.5 trillion lower than maturities based on the borrowing calendar. And given the lower T-bill supply, especially in the 6 months phase and the 3 months, we do expect money market rates to remain healthy going ahead as well, because especially on the longer end, as T-bill supply remains to be quite muted. If you look at the system liquidity, and if we compare today's system liquidity conditions, let's say compared to the pre of elections, especially in the month of April and May, liquidity was quite tight, and the MIBOR was reasonably printing 20 to 30 basis over the policy repo rate. But if you look at in June, post the election results, there was a strong spending from the government of India. There was also a pickup in some amount of FPI flows, and overall liquidity since then has been quite easy. MIBOR is also now closer to the policy rate rather than 30 basis over the policy rate as it was in April and May. So again, this improvement in liquidity is quite helpful for money market curve. More importantly, on a forward-looking basis, at least in the next quarter, liquidity is expected to be healthy, given that the we have lower T-bill borrowings as well as we have favorable seasonal currency trends. So typically in the second quarter of a financial year, that currency usually comes back into the banking system and it leads to better liquidity and slightly tighter money market curve. So overall, the current liquidity situation is quite constructive and quite healthy for money market funds. On the credit and deposit growth, if you look at how things are panning out, RBI has been consistently messaging banks to look at unsecured loan, to look at retail loans, and as we can see, the non-food credit has been moderating quite consistently since the last 3 months. If you look at non-food credit, X of HDFC moderated from 16.2% to 15.5%. If you look at retail loans, they declined from 17.7 to 17.4. And if you look at unsecured loan, they also deaccelerated from 19.6 to 17.9. So quite a sharp decline, as RBI has increased risk weights and consistently warned banks. Given the slowdown in non-food credit growth, especially on the retail loan side, if the current trend continues, probably we may see some further slowdown in consumption. If you look at the trade account widened from the month of April, and it widened from 19.1 billion in the month of April to 23.8 billion in the month of May. One of the primary reasons for the expansion of trade deficit was, one, the rise in oil prices as well as rise in volumes for oil imports, and hence as we can see, the oil imports went from 16.5 to 19.9, whereas if you look at oil exports, they just moved from 6.6 to 6.8. So a lot of this oil import was actually for end use rather than just re-exporting as the usual case has been. If you look at non-oil, non-food imports as well, they also spiked from 34.5 billion to its previous trend rates of about 38.6 billion, largely due to the rise in engineering goods. If you look at gold imports, they were quite stable, still on the higher side, but largely stable if you compare it to the month of April. If you look at service exports, the service surplus exports reduced from 13.7 to 12.9, still a healthy run rate, but largely reflecting a strong domestic economy, as we can see imports picking up from 16.6 to 17.3. Secondly, one of the expectations, from the budget, and as we know, budget is a quite an important event. Everyone is looking forward to it to see how it really shapes up, whether the government boost consumption or they continue with their plan to target capex and to boost long term growth potential for the economy. We continue to expect that the government will continue on its path of fiscal consolidation. So they should print the fiscal deficit below 5.1, which was the interim fiscal deficit in the budgeted FY25 released in February, and also at the same time maintaining their line of capex as well. One of the interesting discussions which have happened in India overall, between market participants and economists, has been the problem of employment, and possibly the lower employment has been seen as one of the reasons for weakening consumption. So here what we have tried to do is we have tried to look at the World Bank data since 1991. So while there could be some data collection issues, but if you look at the trend, since the data is coming from a single source, it's really like-to-like comparison. And if you look at the data from 1991, in fact, unemployment has been one of the most healthiest it has been in the last 30 odd years. What's really possibly weakening consumption is, if you look at the right hand side of the chart, uh, which is the rise in individual tax as a percentage to GDP. So, as individuals not only pay income tax, they also pay wealth tax, customs, excise, GST, etc., whenever they consume anything. So, if you include all the taxes and then you compare as a proportion of GDP, and if you look at how the fiscal consolidation has happened, we can see that most of the fiscal consolidation has been contributed by individual tax. And if you look at corporate tax since FY16, FY17, that's largely remained flat. So as the individual taxes have increased, it's reduced the disposable income in the hands of individuals, and it has led to lower consumption. So given that there is a need to boost welfare spending, there is a need to boost consumption, we are probably expecting that the government may take some steps to boost personal consumption, as well as most of the heavy lifting in terms of revenue collection for correcting fiscal deficit has been done by individuals. So probably going forward, government will try to balance out its need for tax collections, and appropriately taxing various segments of the economy. So we are expecting a balanced budget which will be focused on fiscal consolidation, while increasing its welfare focus, thanks to the higher RBI dividend above about 2.1 trillion, compared to the budgeted expectation of about 85,000 crores. So if you look at the sovereign yield curve, and as we can see on the dark blue line, which is on the month end of 28th of June 24, it's largely flat. If you look at from 5 year onwards, so there is not too much compensation for taking very high duration risk. So if you look at yields, largely they were range bound. In some segments they fell. So broadly, the expectations is that given the fiscal consolidation path will continue, yields continue to be range bound. So broadly on the market outlook, so like we saw on the first slide, when we started the year, the expectation was that growth should decline, but every month continued to surprise on the upside, and now the consensus has shifted that possibly growth momentum will continue. So any shift in growth momentum, as well as any change in the private sector sentiment, like we discussed, that both on the household side and on the private sector corporate side, the profitability has been stronger. So any change in the private sector sentiment or any change in growth momentum can lead to downward surprise in global growth expectations. Any downward surprise in global growth expectations, they help the central banks to kind of proceed with easing. So like we were seeing in one of the previous slides, inflation, although has been coming down, but has been sticky around 2.5%. So one of the reasons for that stickiness in inflation has been a still strong growth. So as that growth momentum undertakes a shift, it does help the case for central banks to start easing, as that sticky inflation can also see downward momentum. Coming to India, like we saw in the previous RBI policy update, two members are already seeing space for rate cuts, given a reasonably low monsoon, as well as very high real rates. RBI understandably and logically is waiting for the whole monsoon to pan out and food inflation to come down, because of the last year experience. As we remember, last year there was an intense heat wave. There was a very weak monsoon, which led to spike in food prices and sharp uptick in inflation. So we do expect that as monsoon pans out, RBI overall does not see any major impact on food inflation. That still can lead to some amount of policy easing in the second half of the calendar year. If you look at liquidity, interbank liquidity is expected to remain comfortable, and where capital flows should be supported by the bond index inclusion. So even though about 8 billion has come out of the 25 to 30 billion, still a 15 to 20 billion dollar of inflows due to bond index can keep BOP and liquidity comfortable. So broadly, the base case for 50 to 75 basis rate cuts in FY25 remains, as inflation is expected to remain in declining trajectory. We believe that moderate duration products possibly provide the best risk reward, given that we are not really expecting one, a deep rate cut cycle, and secondly, as we saw the shape of the yield curve is largely flat. So most of the positives on the favorable demand supply due to bond index inclusion on fiscal consolidation by the government have largely played out. So from an incremental perspective, we think is the short end of the yield curve, which can benefit from rate cuts going ahead. If you look at real yields today, and if you look at the shape of the yield curve, with 3 to 5 year AAA bonds are trading anywhere between 770 to 775, and if you look at average inflation for FY25, that's about 4.5%. So the real rates for a fixed income investor uh, is quite attractive. Investors have today the opportunity to earn reasonable accrual, as well as the possibility of participating in capital gains as the rate cycle turns. However, if the investors have a 6 to 12 months investment horizon, a low duration or a money market strategy will be quite appropriate for them. And if investors have a more than 12 months horizon, a moderate duration strategy, which maintains duration somewhere between 1 to 4 years, like a short-term fund or a corporate bond fund, is more suitable for those investors. So that was largely from my side. We can move on to questions, and happy to share my recommendations on any of your queries. Thank you.
Thank you, Anurag, for sharing your insightful presentation and outlook on fixed income markets. The webinar is now open for Q&A, and I invite participants to share the questions in the link provided and make this session quite engaging and informative. While I wait for questions to queue up, let me begin with the questions that we have already received. Anurag, first question goes like, India got included in global indices, you also mentioned in your presentation. However, markets India got included in the global indices. However, markets remain range bound. Why is so? And what are your expectations on 10-year benchmark GSEC levels in the near term?
So, like we discussed in one of the slides, that post the announcement of the index inclusion in September 2023, there was a lot of investment from the active funds who were tracking the JP Morgan GPI EM index. So as we know, there are two types of funds, active and passive. While passives have to track the index in its totality at all points of time. So a passive fund cannot buy or invest in Indian government bonds till the actual inclusion happens formally. But an active fund has the benefit or the advantage of taking that call, and they could invest well before the actual inclusion happened. And so out of, let's say, 25 billion expected, we already saw inflows about 8 billion, which is one third of the inflows. So if you see, Indian government bonds, and if you compare them to the, other emerging market bonds, they're actually one of the best performers on a risk adjusted basis this year. So a large part of that outperformance that we've already seen in the last 6 months is because of those $8 billion of flows and the optimism surrounding India because of index inclusion. So we would say that a large part of that benefits from inclusion were in the price, but on a steady state or a more medium term basis, the fundamentals for Indian fixed income are quite constructive. So like we saw in one of our slides, the MSP price hikes have been very moderate. If you look at the monsoon, the catch up in monsoon has been quite sharp in the last 10 days. If you overall look at global, commodity prices, they are also quite benign. So overall, from a fixed income standpoint, on a medium term perspective, things are still quite constructive.
Thanks, Anurag. The next question goes like, RBI has set the target inflation at 4%. However, headline CPI inflation for June moved up above 5% levels after showing a slowdown in past 3 months. Fed Chair Jerome Powell recently expressed his concern that holding interest rates too high for too long could jeopardize economic growth. So, in this light, what is your view on the rate cut expectations from Fed and RBI?
Thanks for the question. So, just for the benefit of viewers, it's the government of India which sets the inflation target and which has set the inflation target for 4%. It's largely RBI's responsibility to maintain interest rates to achieve the same target. So RBI is really working with the target, not really establishing the target. But to answer the question, see, from compared to India, US is running a very high level of nominal rates if you compare to the long-term trend. So if you look at the last 20 years trend, interest rates in the US at 5.5% are quite high compared to the trend basis. And if you look at uh, the growth trends, that has started to come up. So from a growth inflation dynamic, if you look at US compared to India, uh, there is a considerable view there that interest rate needs to come off. So we believe that the statements made by the Fed chair uh, were quite reasonable, and they also reflect that possibly we have some space for rate cuts in the calendar year 2024, probably starting from September. As far as India is concerned, I think RBI has been quite constructive on India's inflation as well. So they have taken comfort from a very stable and a very moderate core. What RBI has been concerned about in the past as well as currently is the volatility in food prices. So, what RBI has repeatedly and consistently stated is that these one off food price shocks, although they are one off in nature, but if you continue to experience a series of one off food price shocks, they built into your inflation expectations as well as on your actual inflation on the ground. So, till they see the comfort on these, food price inflation, probably it will not be a fair strategy or a wise strategy to initiate policy easing. One, those price shocks are still there. They can continue to be experienced, like we saw in June when tomato, potato, as well as onion prices went up quite sharply. Secondly, India is not running a very high nominal rate compared to its historical trend. So one, when inflation continues to be high, especially in food prices, when growth continues to be quite strong, when our real rates are still or nominal rates are still quite on the lower side compared to the rest of the world, probably RBI wants to wait for actual data before embarking on monetary easing. So I think both the central banks are kind of right in their ways that one is seeing evidence, which is the US Federal Reserve, they are seeing evidence of softening inflation as well as softening growth. RBI is yet to see that evidence of softer inflation or any softening in growth, and that explains their cautious stance. Nevertheless, we think that probably by September, if monsoon continues to pan out in the way it is panning out, food price, could come down, and that should give some comfort to RBI. Because if you look at, inflation x of food prices, that is quite moderate. In fact, if even if you look at inflation x of vegetables, that's just at 3.5%. So that's a very comfortable and a healthy inflation, which should get corrected in the next 2-3 months.
Sure. Moving on to the question again related to inflation, since no core CPI has continued its downward trend while the headline CPI inched up this month. Do you think this means that it can have some impact on India's GDP growth target of 7.2%?
So, India's growth target, I think, so largely growth is a function of consumption, government spending, and how the global export cycle is panning out. So, if you look at the global exports cycle, as things stand today, it's still quite healthy. Although it is expected to moderate, we do not expect any hard landing for now, and we do expect India's exports to be well anchored. So while they may see some slowdown from the current levels in the next 6 to 8 months, but we are not really seeing any major impact on India's exports. If you look at government spending, in fact, the expectations from the government because of the higher RBI dividend is that the government spending will be much more oriented towards welfare policies, towards rural spending, and with continued thrust on public capex as well. So from government spending also, we are not really seeing any negative impulse for now. And if you look at consumption, yes, consumption is seeing a slowdown. We do expect consumption to remain slow for a while. So yes, the growth estimate of 7.2% can come down, but will it come down meaningfully? We don't have any evidence. We don't think, because already we are seeing a very weak consumption, and the 7% growth that we are seeing is premised on a weaker consumption trend. So it's not really from a delta perspective. We do not really see any major impact on growth going ahead.
Sure. The next question is, on the ground, the real rate of inflation is always higher. And how does that factor in interest rates?
So on the ground, inflation is different inflation for different segments of society. So for someone who's just spending 10% of their income on food, and probably 30-40% of their income on education or housing, inflation could be slightly different for them compared to someone who's spending 50% on their income on food. And that's why different individuals may experience different inflation on the ground. But when a central bank or when a government or any market participant looks at inflation, they look at an aggregate for a nation. So the government conducts a household consumption expenditure survey every 10 years, and as per the expenditure survey done, at an aggregate level, government comes up with a weighted average basket for every sector, whether it's housing, clothing, transportation, purchase of gold, etc. And based on that, the inflation weights are assigned, and a weighted average inflation is derived for the country as a whole. I think so. To the idea is to take inflation, which is representative for everyone. I think usually, and that's why the market participants follow the official inflation numbers. And you're right, it may be different for different people. But if you look at an aggregate, it's the aggregate which matters for policy making.
So, thanks, Anurag. We are receiving some of the question on stock markets. So I would like to inform and request our participants to please share in your questions related to fixed income markets. We do conduct a separate webinar to cover equity markets. So that's where we will take up your questions. Moving on to the next question. Anurag, recently there was an article authored by you in Livent on budget FY25 expectations. And you mentioned in your remarks during presentation also that while government welfare spending has increased, the tax burden on individuals compared to corporates needs to be addressed to boost disposable income and consumption. Can you please elaborate here?
Sure. So in the last 5 years, the government of India has taken a lot of measures to undertake fiscal consolidation. which has also been taken positively by the rating agencies, which has been taken positively by the international investors, which is also reflecting in a very healthy, movement or stability of the INR as well. If you compare INR to the other, Asian currencies, what's happened as the part of this fiscal consolidation is that uh, individual taxes have seen a lot of, or they have largely done the uh, in a way heavy lifting to boost the revenue collection for the government. So what it really means is, so one, individuals pay income tax on their income, but they also pay GST on their consumption. They also pay excise on their consumption. They also pay customs duty on their consumption, so on and so forth. So if you look at the aggregate, so what's happened in the last few years is, as many income tax exemptions have been removed, the tax incidence on individuals has risen, as well as other taxes have overall cumulatively led to individuals facing higher tax as a percentage of GDP compared to corporates, which have seen their contribution as a percentage to GDP being stagnant. So while at an absolute level, yes, taxes paid by corporates have also increased, but compared to individuals and compared to the GDP, they have been largely stagnant. So probably, and that's pure economics, that and pure multiplier effect. So if you reduce taxes, the disposable income in the hands of consumer increases, and that leads to higher consumption. If one increases taxes, the disposable income which is in the hands of consumer reduces, and that reduces consumption, and that has also has a multiplier effect. So one of the expectations that market participants have from the government in due course, whether it will be be possible to correct it in one go, maybe will be difficult. But one of the expectations that market participants and policymakers have the government is probably that this bridge between corporate tax and income tax needs to be slightly reduced, with probably some benefits in income tax that may result in better consumption, and that may also kickstart the capex cycle. Because one of the prime objectives of cutting corporate tax was to kickstart the private sector capex cycle. Unfortunately, that's not happened because, as the corporates are saying, that they are not really seeing too much of consumption, and hence they are not starting capex. So ultimately, corporates, apart from better taxation, they ultimately need a strong consumption cycle to start and to undertake large capital expenditures. So if we have to encourage corporates to undertake large capital expenditures, uh, we also need to boost consumption, which can probably be boosted by correcting some tax issues at the individual level as well. So that's one of the expectation, which anyways there have been a lot of media reports, a lot of other remarks by the government as well, that they are looking at various measures to boost welfare spending, to boost consumption. So but at the same time, they will continue their focus on public capex. So it bodes well for overall growth potential of the economy, that they are using this RBI extra RBI dividend to maintain their capex while providing some welfare relief to individuals.
Thanks, Anurag. In the interest of the time, I will take two or three questions more. So the next question goes like, how can government address the fall in consumption despite strong wage growth and increased rural spending to ensure sustainable economic growth?
I'm sorry, how can government?
Address the fall in consumption despite strong wage growth and increased rural spending to ensure sustainable economic growth.
So, like we discussed, in the previous question, largely consumption is a function of one, employment growth. It's a function of wage growth within the employment sector. and it's a function of the disposable income. So if you look at wage growth, especially in the organized sector in the last 5 years, that's been quite healthy. If you look at employment growth also in the organized sector, that's been quite healthy. Is the disposable income growth, which has not really happened for a lot of uh, consumers. So probably as the government focuses on giving tax reliefs to individuals, that should boost up disposable income and lead to better consumption going ahead. But these three are largely the drivers for consumption.
Sure. The next question is, you have maintained your stance of shallow rate cut cycle of 50 to 75 basis points. Can you please elaborate it more on your rationale for this shallow rate cut cycle?
The rationale for shallow rate cuts largely stems from the strong growth that Indian economy has been enjoying for the last 2 years. So, and it is expected to enjoy at least for the next 12 to 18 months as well. So, while there could be some downward surprise on the 7.2% GDP growth projection by the RBI, but even the downward surprise is expected to be somewhat moderate, given that we are still expecting a 6.5% growth plus for India, at least in the next 12 months, we really do not see a growth shock and hence a need for RBI to cut rates very aggressively.
Sure. The next question is, since the government spending is now starting and the system liquidity is improving, how does it is going to be beneficial for the funds which are on the lower end of the curve?
Right. So if you look at the period of April to May, liquidity on the interbank side was tight because of the model code of conduct, due to which the government could not spend and government cash balances with RBI was quite high. So as we would recall, uh, the government cash balances are not part of the banking system and they remain with RBI. When government decides to spend that money goes from RBI to the interbanking system and it results in increase in liquidity. And that's what's largely played out in the last 1 month post elections as the government has started to spend aggressively to make up for the 2 months of lower spending. Liquidity has increased and money market rates have come down. But even if you look at today, compared to an overnight rate of 6.5%, even a March, for example, CD is trading somewhere close to about 7.4%. So that's a good amount of 90 basis spread that a 9 month strong PSU paper has over a overnight rate. So for investors who have a more than 3 months or more than a 6 months investment horizon, can consider money market or low duration funds as well to capture the higher spread between the overnight rate and these 6 months to 12-month assets. Because as the liquidity remains comfortable, and as expectations of rate cut increase, we could see some, rate levels in these money market papers also coming down.
Thanks, Anurag. My next question is little long. Uh, Given the outlook for the shallow rate cut cycle, which fixed income products or strategies do you recommend from optimal risk reward? Also, how should investors decide to go for longer duration or gilt strategies or any other fixed income strategies like ultra short duration or money market? And currently, what is advisable mode of investments, SIP or lump sum? And also how to look at the interest rate risk, global risk. Uh, Over to you.
Right. So any asset allocation has to be a function of risk appetite as well as time horizon. So if we kind of combine our view on interest rates with an investor's investment horizon, given that we are expecting a shallow rate cut cycle, a moderate duration product we believe is well suited for an investor, given the starting level of real yields that these funds are enjoying, and the potential to participate in MTM gains as the rate cycle starts. So probably an investor who has more than 12 months investment horizon can consider a moderate duration fund like a short-term fund or a corporate bond fund. If an investor has a 6 to 12 months investment horizon, like we explained in the previous question, a money market or a low duration or even an ultra short term fund can be considered by the investor for their short term liquidity requirements, which give them a good amount of liquidity as well as a very limited interest rate risk compared to long duration funds. And while providing a reasonable accrual at the same time as well. Uh, as far as the allocation to long duration funds are concerned, they can be considered either when the valuations are very attractive, hence giving them a very high margin of safety, or when an investor is expecting a very deep rate cut cycle. Given that we are not really expecting a deep rate cut cycle, uh, or we don't think the valuations at this point of time are very attractive, we recommend investors to stay invested in moderate duration funds. Uh, Given that the valuations at this point of time are quite reasonable, we do not think the waiting period, at least as far as fixed income is concerned, really needs to be concerned about. So investors can invest in lump sum as well. Thank you.
Thanks, Anurag. On behalf of UTI Mutual Fund, I convey our sincere thanks to all the participants for participating today and asking questions. Please share your feedback on the link provided. Special thanks to Anurag for sharing valuable insights. We look forward to connecting with you in our webinar next month. And with the closing remarks from Anurag, we can conclude today's webinar. Thank you. Good day.
Thanks everyone for joining on the webinar. Hope you found the session useful. Please dial into our post-budget call as well, and we'll be sharing our insights on the budget as well, which we believe will should help you get the right information on that event as well. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.